Isaac Newton was one of the greatest analytical minds in human history. He invented calculus. He formulated the laws of motion and universal gravitation that governed Western physics for 2 centuries. He was the warden and then master of the Royal Mint, where he demonstrated administrative and financial competence that went well beyond the purely theoretical. He was, by any measure, among the most rigorous and disciplined thinkers England had ever produced. In 1720, Isaac Newton invested in shares of the South Sea Company. He bought early, watched his position double, and sold at a profit. Then he watched the share price continue to rise. Then he bought back in at a much higher price. Then the price collapsed. Newton lost approximately £20,000, equivalent to several million pounds in present-day terms. He reportedly said afterward, "I can calculate the motion of heavenly bodies, but not the madness of people." Newton's loss was not unusual. It was shared by members of Parliament, cabinet ministers, aristocrats, merchants, clergymen, and ordinary tradespeople across England. The South Sea Bubble of 1720 was the first modern financial crisis, the first event that displayed, at scale, the full anatomy of speculative mania, from irrational exuberance through catastrophic collapse, and its architecture is recognizable in every financial crisis that has occurred since. The South Sea Company was incorporated by royal charter in 1711 during the War of the Spanish Succession. The company's ostensible purpose was to conduct trade with Spanish colonies in South America and the Pacific. The South Sea of its name referred to the South Atlantic and Pacific Oceans. There was a significant problem with this purpose from the outset. England was at war with Spain. Trade with Spanish colonies was not currently possible and would depend entirely on the terms of any eventual peace treaty, which had not yet been negotiated. The company was, in essence, a vehicle built around an anticipated commercial opportunity that did not yet exist and whose terms were entirely uncertain. What the South Sea Company actually was, in its first years of operation, was a mechanism for managing the British national debt. The government transferred a portion of its war debt to the company in exchange for shares. The company received an annuity from the government, interest payments on the debt, and in turn sold shares to the public with the promise that future trade profit from the South Sea would generate returns on top of the government annuity. The structure was, as financial historians have noted, fundamentally speculative. The actual trade revenues were minimal and the commercial monopoly was largely theoretical. But the government backing gave the enterprise an aura of legitimacy and the promise of South American trade wealth. At a time when Spanish silver from the Americas was the most visible emblem of commercial empire in the world, gave it an aura of almost unlimited potential. The company's management, under the leadership of John Blunt, developed a strategy in 1719 and 1720 that was, in retrospect, an almost textbook blueprint for manufacturing a speculative bubble. The central mechanism was the conversion of additional British government debt into South Sea Company shares. The company proposed to Parliament that it should take over more of the national debt, tens of millions of pounds, in exchange for shares valued at whatever the market price happened to be at the time of conversion. This created an extraordinary incentive. The higher the share price, the fewer shares the company had to issue to absorb the same amount of debt, which meant the existing shareholders' equity was diluted less. The company and its existing shareholders had a direct financial interest in driving the share price as high as possible. The methods used to drive the price upward were comprehensive and, by modern standards, comprehensively fraudulent. The company extended loans to prospective shareholders, using the shares themselves as collateral so that people without cash could participate in the price appreciation. This mechanism inflated demand artificially. It also created a dangerous feedback loop. If the price fell, the collateral backing the loans lost value, forcing margin calls that required selling shares, which drove the price further down. The company bribed members of Parliament and government ministers, in some cases with shares issued at below-market prices or with fictitious profits booked on the company's books as if the ministers had participated in profitable trades. The list of recipients included figures at the highest levels of British government. The goal was to ensure regulatory protection and parliamentary enthusiasm. The company's management also spread optimistic projections of trade profits that bore no relationship to commercial reality. The Treaty of Utrecht in 1713 had, finally, granted England some trade rights with Spanish colonies, but not unlimited trade, and the actual volume of legally permitted commerce was far smaller than the company's promoters implied. The gap between the promise and the commercial reality was enormous and was known to the company's management. Between January and June of 1720, South Sea Company shares rose from approximately £128 per share to over £1,000 per share, a gain of roughly 800% in 6 months. The collapse, when it came, was as swift as the rise. The mechanism of the peak and the subsequent fall is instructive. As the share price reached extraordinary heights, the company's management and insiders began selling their own positions. This was not publicly disclosed. Meanwhile, other speculative ventures, inspired by the South Sea Company's apparent success and taking advantage of the same speculative appetite in the market, were proliferating. Parliament passed the Bubble Act in June 1720, which restricted the formation of new joint stock companies without royal charter. This was ostensibly aimed at suppressing fraudulent ventures, but was actually largely lobbied for by the South Sea Company to eliminate competition for investor capital. The Bubble Act had the effect of restricting capital that had been flowing into competing ventures back toward the South Sea Company briefly. But when investors in those competing ventures were forced to sell to meet obligations, the selling pressure spread. Confidence began to crack. In August, share prices started falling. In September, the collapse accelerated. By October of 1720, shares had fallen from over £1,000 to around £150. The wreckage was extensive and socially distributed in ways that amplified the political damage. Members of Parliament who had accepted bribes were now sitting on massive losses and implicated in a fraud. Government ministers were compromised. The Bank of England and the East India Company, which had been drawn into the bubble's orbit, faced their own liquidity pressures. Thousands of ordinary investors, people who had borrowed against future price increases, who had sold real assets to buy shares, who had staked their financial futures on the promise of South Sea wealth, were ruined. The political fallout produced one of the most dramatic accountability moments in British parliamentary history. A parliamentary investigation, driven by the outrage of a public that demanded answers, uncovered the bribery, the fraudulent bookkeeping, and the insider selling. Robert Knight, the company's cashier who held the records of the political bribes, fled to France rather than testify. The French refused extradition despite British diplomatic pressure. Several directors were arrested. Their assets were seized. Some were expelled from Parliament. Robert Walpole, who had initially opposed the South Sea scheme and was therefore relatively clean in the aftermath, managed the political and financial stabilization and emerged as the dominant political figure of the following decade, arguably the first British prime minister in the modern sense of the term. His political ascent was built on the wreckage of the bubble. The South Sea bubble's enduring significance lies not in its specific facts, but in its structure. Every major financial bubble since 1720 has followed, with variations, the same basic architecture. A genuine underlying opportunity exists, or plausibly exists. Financial instruments are created that allow participation in the upside without direct exposure to the underlying commercial reality. Prices begin rising, and rising prices attract more buyers, whose buying drives prices higher, validating the decision of those who bought earlier and attracting still more buyers. Credit is extended, allowing people without existing capital to participate, expanding the buyer pool and further inflating the price. Insiders sell at the peak while publicly maintaining confidence. The price reaches levels at which no realistic projection of future earnings can justify it. Something, a piece of news, a liquidity squeeze, a loss of confidence, punctures the narrative. Selling begins. Credit that was extended against the collateral of the now falling assets generates margin calls that force more selling. The collapse accelerates. The tulip mania of 17th century Holland, the railway mania of Victorian England, the 1929 Wall Street crash, the Japanese asset bubble of the 1980s, the dot-com bubble of the late 1990s, the American housing market of the 2000s. Each of these followed the same pattern, adapted to its specific technology and regulatory environment. Newton understood gravity. He could not outrun the same force applied to crowd psychology.